What are the margin requirements for SPY options? Have you ever wondered what it takes to trade SPY options and what margin requirements you need to keep in mind? Let's break it down so you can trade with confidence. First, let's clarify what SPY options are. SPY options are options on the SPDR S&P 500 exchange-traded fund trust, which tracks the S&P 500 index. When you buy SPY options, you pay the full premium upfront. This means no additional margin is needed beyond the purchase price. However, selling options is a different story. When you sell or write SPY options, margin is required. This margin acts as a safety net for your broker against potential losses. For uncovered or naked short calls or puts on SPY, the initial margin requirement is usually the greater of two calculations. The first calculation is 20% of the underlying exchange-traded fund's current market value minus any out-of-the-money amount, plus the option premium you received. The second calculation is a fixed minimum amount per contract, which is often $2,000 or 100% of the option premium received, whichever is greater. This means you need enough equity in your account to cover potential losses if the market moves against your short option position. If you hold 100 or more shares of the SPY exchange-traded fund and write call options against those shares, you can reduce your margin requirements. This is known as a covered call. To qualify for margin relief, the total value of your SPY shares must equal or exceed the aggregate exercise price of the call options sold. However, if the value of your SPY shares falls below 95% of the aggregate underlying index value, you will lose that margin relief. You can regain it by purchasing or depositing additional SPY shares to bring the total value back up. For traders with portfolio margin accounts, the margin requirements for SPY options can be lower. This is because risk is calculated based on the entire portfolio's net risk rather than individual positions. Portfolio margin uses advanced risk models to determine margin, often allowing for more leverage on SPY options if you have offsetting positions. It is also important to consider that margin requirements are influenced by Federal Reserve Regulation T, which typically requires 50% for long stock positions, as well as rules from the Financial Industry Regulatory Authority and broker-specific requirements. Brokers may impose higher margin requirements based on account type, concentration, or the volatility of SPY options. For example, brokers may requiring 30 to 50% margin on long SPY positions and 30 to 50% on short positions, adjusted for diversification and risk. If you plan to sell SPY options naked, make sure you have sufficient margin to meet both initial and maintenance requirements. Using covered calls by holding SPY shares can help reduce your margin and risk. If you actively trade SPY options, consider a portfolio margin account for more efficient use of your capital. Always keep an eye on your SPY shareholdings and option positions to maintain margin relief and avoid margin calls. Understanding these margin requirements can help you manage your risk and capital effectively when trading SPY options.